Hello, hello. Alibaba has just vaporized about $17 billion or 120 billion in Chinese yuan into AI and cloud infrastructure over the last year. Now, notice that in the latest quarter, Alibaba has been borrowing money to pay dividends and also do buybacks, stock buybacks, using debt and convertible notes. In the meantime, the China e-commerce profits cratered 76%, not doing really well here. On the other side, flip side, quick commerce is growing, but how much are they paying for it? And I wanted to examine this because you will see that they have sales that are up 60%, so 60% revenue is up for grocery and fast delivery business. However, there is a catch, the fact that they are using heavy discounts to get those sales. They won't say how much, but they're actually spending, that they're actually spending here, but they are spending it. And the thing is, I've talked about it in the past, you don't really want to be getting revenue from subsidies. It's not great because it inflates the top line, it inflates the revenue. And this is what's happening here. You will see in the key investment stories what we already saw, spending big on AI without much profit to show for it yet, as they spent the 17 billion I said, and their actual bank balance has dropped as well in the last over the last 6 months. We will examine on this with the numbers a little bit later. Cloud and AI are growing, as you'll see. They brought in almost 50 billion won this quarter, and the AI tools like Quen, their model is exploding as well. It's doing well. Now they are not saying how much they are charging there or what profit margins look like, but we do know that it's doing better. Now, let's go back and examine in detail what is happening with the numbers of the company. As another thing to keep in mind is the fact that marketing spend also doubled to keep customers. So sales and marketing expenses exploded to nearly 27% of the revenue here. And the bottom line of this is you kind of have to monitor retention, see what's happening here with spending all this money with marketing, and see if it converts to margins and all that. Now, if we take a look at the actual financial statements, we should always do that regardless of the AI already telling us the story. You will notice that the revenue of the company has been growing through the quarters, and also if you take a look at the annual, you will see that the revenue has also been growing. So the company is not really suffering in terms of their revenue. It's actually the problem is the fact that they are spending a ton of money in free capital expenditures right now, and so their free cash flow goes down, for example. We will see that, but notice again that we have here 130, 137, and even in the last 12 months keeps increasing as well. So doing well. However, take a look at the selling and marketing. Back in 2026, it was like 2 billion. Now it's 28 billion. Amazing increase, right? So they're spending multiple times that much for marketing. Interesting to see for the company so that you know exactly where the money is going to. With the operating income coming down a little bit as operating expenses become much higher through the years, way higher. Now, net income is still fine, and remember back into 2021 or 2022 actually, when we had COVID and all that, the company was doing badly in terms of their net income, but this is when I was basically saying that I bought, and I did buy back then, did really well, and I think that this was something to be expected. You know, there was the geopolitical risks and all that back then, not so much anymore, if not any anymore. And so now the company is going back to growth territory. And notice that we are sitting at similar levels to what the company used to be, and significantly more actually, back when it was like $300. So eventually, I do expect that the company keeps growing if they do well with what they are planning right now, with their capital expenditures being spent for AI, cloud, and all that. Now, the other thing that is very interesting is the balance sheet. Because the balance sheet tells us a story. Take a look at 2021, where they had cash and cash equivalents and short term investments of about $80 billion here. And now it's sitting at about $40 billion in the latest quarter, indicating that they are spending a ton of money, which we already saw. It's buybacks, it's also spending money for the dividends that they are paying. They're paying a little bit of a dividend. Capital goes out because of capital expenditures is another thing. And buying back shares, all of these matter. Take away cash from the company. They are getting also debt to service that, as we already saw. And you can see it in the liabilities of the company. Like if you take a look at the liabilities or the debt of the company, you will see that it keeps increasing here, significantly so. From 2025, the latest quarter is like plus $10 billion. Again, this is something that they are doing and they are aware of it. So it's not like the business is doing bad. It's something that it's a decision basically. And the other thing that is really important is the fact that the company's free cash flow has been going downwards, again because of tremendous capital expenditures. Notice here the capital expenditures of the company. Back in 2016, they were less than a billion. Now they're 18 billion in the last 12 months, and significantly increased from 2025 as well. So spending a ton here. This is why the free cash flow for the last 12 months is barely positive. And if you take a look at the actual quarters, some of these are actually negative, including the latest one. So the latest quarter, you will see it's negative free cash flow. Very interesting. Again, it's what the company is doing on purpose. So they are spending a ton in capital expenditures. Look at the increases. These are quarters. So look at the increases. We're seeing like 5 when it was like 1 or 1 here, 500 million. Significant increases. Now, if we go to, let's actually first go to the dashboard because it will give us the metrics and you can see the story with the metrics like at a glance as well. The P ratio is heading downwards again because the company has, for a while, it was actually having increasing PE because, you know, the stock price was increasing quite a lot. But right now it's sitting at a territory where it's like about 25 when compared to the net income is at a normal spot for a company of this caliber, I should say. If not, maybe a little bit cheap for these days, since these companies are growing tremendously. Now, outstanding shares are going down. We saw that already. They are actually getting even debt to buy back shares. And the price of free cash flow incredibly high. And this is because of the 167 million or so that we saw earlier, basically making no free cash flow right now. And this is why this has skyrocketed. Same thing with the total liabilities compared to the free cash flow. Now, the total equity going down a little bit as well, understandably so without the buybacks. And the free cash flow, what we saw, almost negative territory soon, in some quarters already actually. But the margins of the company still comfortably high, with the operating margin being the only exception which has suffered, as we saw already. And the returns of the company pretty much sitting at sort of like similar territory to what they used to be, with the company actually having little debt compared to the equity that they have. Now, the other very interesting thing to notice, and I always like to see this, the stock alerts, because they give us a nice graphical representation, very quick one, about the company's financials. This is what I like to see. I'm not going to take too much time here because these are too many, and this can be a video of like an hour if we want to. But what I want to explain is the fact that the margins have been increasing annually. However, there is margin pressure in Q2. The operating margins we saw already, right? Q2 have suffered tremendously. This is why this is a 4 and not a 5. The capital efficiency of the company tells us the return on invested capital is sitting at $10 right now. Now, notice this, but also notice the return on incremental invested capital. So let me quickly explain what this is because it's important. It was like almost 34% or something, right? 32. What this means is, let's say that I invested $100 into a business. I'm making 10 right now, or 10.7 on these $100. That's the return on invested capital. But for the new capital that I employ, the incremental capital, I make $32. Meaning that I'm making way more money when I'm investing new money into the company. Makes sense? And what is invested capital? Invested capital is two things. It's debt and equity. Debt, basically, think about it like a bank loan or notes. And equity is basically selling shares to shareholders, like issuing shares and selling them in the open market. So this is what this means. Very important. This is a very, very important metric for the company. And the incremental margins here, notice that they show the same story. They depict the same story here. They are 14 with incremental ones being 25. It's the same thing here, basically telling us that the margins of the company are massively better on new capital, as new capital is employed, new sales. In this case, it's new sales, basically, it's new revenue. So better margins on new revenue. And earnings quality has suffered a little bit, as I'm getting this weird. Okay, earnings quality has suffered a little bit, because we're sitting at 1.3 right now when it was 2.09. Understandably so, because again, operating cash flow is an important piece of this, and this has suffered. So very understandable, as it's weakening in Q2 is what we saw. And also understandable here, the free cash flow quality compared to owner earnings, very understandably the same story. Again, because the free cash flow has suffered. And also the capital needs of the company are heavy, because of the fact that they're spending a ton in capital expenditures, understandably so. This is what we're seeing here, a combination of the free cash flow and the owner earnings getting some suffering here. All right, so the debt coverage of the company tells us if the company can service debt based on the earnings that they make. So this is lower and has been lower for a while. No reason for concern. Share dilution. The company has been buying back shares. 11% in the past 5 years is amazing. So this practically means that your shares are actually intrinsically worth 11% more because they are actually buying back and retiring them. However, there is a little bit of a nuance here, and these two cards, which are working together really amazingly, I like these two a lot, tell us two things. First of all, how much the company pays in stock compensation to employees as part of the revenue, which is very important, and it's been going down. It's something that I like to see, obviously. And also, what's the quality of those buybacks that the company makes? Because if you are making buybacks, if you're buying back shares, are you actually retiring those shares? Or are you actually giving them to your employees as compensation? Effectively not making any gains for me as a shareholder. Do you understand this? It's like, I'm not really retiring them. I'm actually giving them to somebody else. So it's sort of like, it's not great. Like the best thing is to retire them and not being there in the open market. So now there are actually less shares in the open market, making my shares worth more money is the thing. And this is exactly what is going on with Alibaba here. And you can see that the share change compared to the buybacks tell us a story of the company actually buying back shares, but not really giving them back to employees, not increasing employees' compensation with shares. And this is what is important here. So effectively telling me that the share count of the company means that when it's going down means that actually my shares are worth more and not giving to somebody else. Goodwill risk here, you will notice that this is about the same for all years. This means that the company had made some acquisitions, and if they had write-downs, this would be much worse numbers here. These are not concerning here and haven't been concerning for a while, even better actually. But if the company actually had to write down acquisitions, basically losing money on them, then this would be like 1 or 2 or something. So if an acquisition went wrong, basically, or more of them. Inventory is not a huge deal here for Alibaba, so this is just some information here. Kind of the same with receivables here, generally speaking, so telling me how fast how fast I'm getting money from customers, and this is about the same, maybe slightly slower, but okay, not a big deal. And the asset maintenance here tells me how much capital expenditures the company is spending compared to the depreciation that they have. And this used to be high in 2020 and then went lower because the company haven't been spending capital expenditures. But now with the super increase in capital expenditures, this has also increased, indicating that the company is investing pretty much, so investing money, and even more here in Q2. Accruals is a little bit more involved here because it tells us the quality of the profit, and this is a little bit convoluted and you can read the details here, but basically effectively tells us how much of the cash becomes earnings, pretty much. So for instance, if a company reports 100 million in net income, they only generate 16 operating cash flow. Where's this 40 million in profit pretty much going? It's just paper. It's called accruals pretty much. But why this can be a red flag? Basically, it can be some sort of an accounting. It's like, for instance, booking sales before cash and understating reserves, capitalizing expenses, inventory gains, and things of that sort. And companies over the past, like Enron, for instance, take a look at this, reported billions in profits, for instance, but operating cash flow was terrible and declining. And so the fraud was that they were booking profits from long-term energy contracts immediately using mark-to-market accounting, even though no cash would be received for years. So you get it? It's like the money that we see there, the paper money, is it actual cash, is what this is telling me. And this is fine here for Alibaba. Depreciation adequacy. This tells us, and this is the thing that actually, again, you can see in the card here, Barry mentioned that, Michael Barry, the big short guy. He flagged this for companies like, I believe Google, for instance, was one. And if you take a look at the tool, you will see that Google has actually one here. And by the way, you can take a look at the tool at AIinsights.com if you like. There's a free account too, and you can see all the things that I'm saying. Now, implied asset life, and you will see here what this means. Think about it this way. Let's say, actually, I have an example that illustrates that even better with the cost of a data center, for instance. Take a look at this of a server. For instance, if you depreciate, let's say you have a server that costs $10,000 and you depreciate it over 6 years. So this is like 1,600 of depreciation a year. But if it's only useful for 3 years, you should expense it for $3,000 a year. So the difference basically is profits. So making earnings look better than reality. And this is what Barry was saying, that they have slow depreciation schedules, basically. Now, this card, I have made it in a way that will use different depreciation times depending on the industry. And I have actually curated this myself. So, for instance, if we're talking about a company that has tractors, like a farming company, for instance, these are going to be depreciated way slower, like maybe even 30 years, but a server could be like 3 years or 5 years. And so I have actually carefully curated these numbers here to be different for every industry, pretty much. But for this one, the benchmark is 6 years, as you'll see. And you will see that the company has, for the most part, been staying around there, with a little bit of an increase here lately, and was really bad back in 2020. Altman Z-score tells us the risk of bankruptcy, anything above 3 is very safe, and this is what you see here, we're in the safe zone. So this is what I had to say about Alibaba, and also before we close the video, we can do a stock evaluator here just to see where we are with our intrinsic value in terms of the free cash flows of the company. Remember, it matters whether the company is spending a lot in capital expenditures, of course. And I will calculate it with our default scenario here, which is the Stock AI Insights Lucky 13. And we are sitting somewhere between 140 maybe to 172, 180, somewhere around the current market price, maybe a little bit more expensive and overvalued. However, you know the story of the company now, and to summarize it, the AI actually summarizes it really nicely here with the key takeaways. 3 things that are concerns: negative free cash flow driven by large AI cloud and quick commerce investments. Sales and marketing expenses has doubled, you saw that already. And earnings quality masked by investment gains, also told you about this, with a comprehensive gain becoming a part of net income these days. And market leadership is obviously great in China. AI cloud, so doing well. Large cash and liquid equivalents, even though they have been spending a lot. And a massive ecosystem scale, of course, understandably so. This is what's happening with Alibaba. Tell me, guys, what do you think about this company, whether you are buying it or not? And I'd love to hear your comments. What do you think? And if you enjoyed this kind of analysis, leave a like. That helps me a ton. And subscribe if you are new around here, because there will be more. Thanks for watching. Bye.